Hi there, Deanna LaRue with TimeWise Financial. I wanted to take some time today to share some of our team's thoughts on our current economic environment. I know that this has been a very complex investment year. We've got a war in Europe, troubles with energy and food and the refugee crisis. There's the zero COVID policy in China, inflation, supply chain issues, and everywhere in the world raising interest rates, and then the midterm elections. So a lot going on this year. But in these difficult times like this, I just like to remind you of why we stick with the equity markets. With the equity markets, we've got 95 years of data. And what we can see from this data is that the average rate of return from that over the history is about 8%. And this is to include a lot of those down markets, or as we like to call them, bear markets. But this is the highest return of any asset class out there. But in order to get that return, you have to endure some volatility like we've been seeing and have seen before in our lifetimes. So what's going on now? Where is our silver lining? Well, first we look to corporate profits. And corporate profits are showing growth of about 6%, even with the markets being down. And so that is always a great sign. Second, we look at recession indicators. Even if we were technically deemed as entering a recession, we really feel that the downside is not going to be substantial if we do get that news. Historically, in high inflation, recession times like we have now, with corporate profits still being up, typically equates to a very soft landing in the markets. So you may be feeling like, oh my goodness, I can't handle this, just sell everything and put it in cash. But I would urge you to hang in there, because the typical recovery after a down market can be very quick, like 3, 4, 5 months, which is what history has shown us in markets compared to what we're in today. So if you're trying to time the market, you have to be absolutely perfect with this timing, and would likely miss the first month of recovery and then potentially miss the entire recovery. Third, we look at the efforts of the Fed raising rates. What they're trying to do is to reduce the demand for goods to lessen the inflation that we've been seeing. And we are seeing some results of these moves by the Fed. Some think that the September inflation number was in all likelihood the peak, and now forecasting a more neutralized rate of between 3 to 4%, hopefully by next May, if everything were to go right. So we do feel that the Fed will continue to raise rates even further. But in history, after a peak inflation, like what we think we saw in September, it's always been very favorable to the markets after that peak inflation number. Fourth, we look at our labor markets, which currently are very strong. Jobless claims are still very low. And if you think about this, 70% of our economic growth comes from consumer spending. So us out buying goods and services. So if the consumer has the job, then they're typically spending money. We do, however, have a labor shortage. I think that CEOs and corporate leaders are realizing if you fire people, you may have a hard time getting them back, like we saw after COVID. And so they may think twice before jumping into layoffs, which would keep our labor force employed longer. And I think that the answer to the shortage will be automation in factories and warehouses. And there are a lot of US businesses that are really excited and looking to take advantage of the new technology that we have in order to develop this automation in those factories and warehouses. If we look at the history of midterm elections, so history shows that during every midterm election that we have seen, we typically see a bottom around October and then a very quick recovery towards the end of the year. Also, what happens typically after a midterm election, or what has happened in the 12 months following every midterm election that we've had, is that the markets have been up and rallied on average 15.1%. So we don't want to miss that rally. And the reason for this historical recovery is after midterm elections is typically that the party in power starts to remind themselves, okay, we've got another election for presidency coming up in 2 more years. We want to focus on growth and we want to get those votes. So with all of this being said, the best way to get through this is to continue being invested in a diversified portfolio. We are and have been setting our portfolios up to take advantage of the opportunities that we're presented with. So for example, we know that the US economy is the strongest out of all of the developed markets. So overweighting US holdings, looking at large cap growth, small cap value opportunities, adding commodities, which commodities is such a great diversifier because they typically don't act like stocks or bonds. And with interest rates going up, starting to add a bit more duration back to our bonds. Because in all reality, we need bonds to behave like bonds again, providing those higher rates of return for our safer buckets of money. So in summary, we are very optimistic of the future of the markets, but we do expect more volatility in order to get there. And you guys know that we are always available for any questions or any fears that you may be feeling. Please don't hesitate to give us a call. And we look forward to continuing to keep you informed through all of this. So thanks so much for your time today.